one of the biggest comments and the most frequent comments that I get is that I can't invest into real estate because I don't got 50 G's, 100 G's.
Exactly.
So like even my 2 kids here, not like my blood kids, but my boy Yas and my boy Parsa, these guys, like all they need is 5K. They have no excuse. You know what I mean? So for everyone who says you need to have 100K to get into real estate in the Greater Toronto area, we just debunk that.
Absolutely.
Right?
2 months ago, I was having a conversation with a potential client.
Yeah.
She was an undergraduate student.
Okay.
Right? At McMaster. Doesn't have a lot of money, doesn't even have a full-time job, but she wants to be involved. She wants to take a front driver's seat position in engineering her future.
Yeah.
And I gave her the opportunity to do that in ways that in maybe another real estate investment firm or going out and getting 100K down for a down payment, just it's too prohibitive, right?
So let's talk this 5K through for a second, because the 5K could be 100K. It's all the same thing. Like the returns are based on how much you actually invest and where we actually put the money. What happens? What does Equiton do now with that $5,000 investment that Yas makes?
Okay, that's a good question. So specifically what we do at Equiton, I can kind of distill down into 2 things. And they're 2 sides of the same coin, Jazz.
Okay.
On the one side, we're real estate investors, right? We aggregate capital together from various investors, all types, all walks of life. And we go out and we deploy that capital in real estate, right? Very, very simple. But that's the smallest part of what we do. The engine of what we do, the soul of Equiton, so to speak, is we are asset managers. We preside over every investment we make throughout that investment's life cycle. So when I talk to you about Equiton as a company, we're really a team of about 120 employees, most of which are real estate professionals managing these assets. And all of that's done in-house, like I said earlier. So we would raise capital as little as 5K, as much as $1 million plus, depending on the person's situation. We aggregate that into a pool, whichever fund they choose, depending on their comfort level with risk, the exposure they want, the return structure they're looking for, so on and so forth. And we are going to execute that strategy and pass through the returns to them. And there's 2 types of returns we offer. One is a cash flow component. So both of our funds generate cash flow on a monthly basis. So for those investors, we can offer that. And there's also a capital appreciation component as well. You're going to see both of those on our fund side.
On the fund side?
Yeah.
Okay. And so Yas puts his $5,000 into this fund. It gets mixed in with Parsa's $1 million, for example, that he might put in. And Yas will get a monthly payment on that $5,000.
Exactly.
As well as the appreciation.
Exactly.
Okay. That's very important for some of my viewers and listeners that are that 22, 23 years age. And in fact, in Ontario, you just need to be 18 years old,
that's right.
Just to confirm. So it's very simple. Because a lot of people have heard about these terms like accredited investor, eligible. Here, you just need 5K and you can invest.
Yeah, specifically on the fund side, you got it. We don't want to preclude people from investing, right? We want this to be an inclusive thing. Now, in years past, these types of private equity investments, they were reserved for the richest of the rich 100%. And institutions, right? Like pension funds, university endowments, so on and so forth. Now, we have completely spun that paradigm on its head. We want everyone to be able to take part if it's something that works for them, right?
Now, Yas puts in this money, whatever month we're in right now, July. He gets paid something in August and September. Does he have to leave that 5K in there for a certain amount of time?
Yes. So we do have a minimum hold period on the investment.
Okay.
It's generally speaking 5 years.
Okay.
However, it is what we call a soft hold, which means if you need access to you invest 5K today, Jazz, maybe in 6 months, family emergency, you got to move back to Guelph where you're from or whatever the case may be. You have access to your capital at all times, right? We're never going to keep an investor from their capital for whatever reason. The way we impose that 5-year hold is by imposing early redemption fees for the investors that redeem before the 5-year mark.
Okay.
It's not meant to be taken advantage of, but in an emergency situation, if you need the liquidity, it's there for you.
Okay. And can he use all types of capital in terms of cash under his pillow? He can use a line of credit. Can he use RRSPs, like registered funds?
You got it.
Okay.
So we can accommodate any investment under the sun. So the TFSAs, RRSPs, LIRAs, RESPs.
Can you use a credit card out of curiosity?
Sorry?
Can you use a credit card?
I don't think you can use a credit card.
I'm just asking.
But I
know
have had
somebody's
many investors,
watching. Yeah.
especially in years past in a lower interest rate environment,
Yeah.
they'll pull 50,
wouldn't be a
60K
smart move,
out
but
of
I just
their
want to,
HELOC is for what, 2.5%? They'll invest it to get their 6% cash flow, and they'll take the difference every day of the week.
Right.
Right? So now we don't recommend doing that, especially in this high interest rate environment, but
Right.
options are available to our investors. We also do corporate investments, joint investments amongst spouses, business partners, really any way you want to structure the investment, Jazz, we can accommodate.
Okay, and then what's your guys' process? Like, you know, you're sitting down with a 22-year-old guy, for example, yes, or you're sitting down with a 60-year-old person. Obviously, the conversation is going to be slightly different because their questions are going to be different, but they're also in different periods in their life, right? And yes, could, in my opinion, someone at that age can put it into something a little bit more riskier.
You got it.
Right? At 60, you don't want to, you know, you're not going to be as risk adverse. Now, what's your guys' process when someone like Yas sits down with you? What's your guys' process? Like what questions should he be prepared that you're going to ask him?
Yeah, that's a good question. So we have two different funds with differing strategies, different risk profiles, so on and so forth. Every conversation I start with a potential client or an existing client is why. Tell me your why. Why are we having this conversation today? What brought you to me? What are you looking for in an investment? What's your current portfolio like? Right? And in starting this conversation, it allows them to tell me what they're looking for. And based on the feedback I receive, I can help guide the conversation into an investment that makes a ton of sense for them, instead of trying to push a product on them that isn't going to satisfy any of their investment goals.
Right.
And there's no sense in doing that because they're not a satisfied investor, which eventually bleeds out. Right. So
now what type of investments, like you said, products, for example, can you talk a little bit more about what products are available for like within the inventory of Equiton?
For sure. So really, we're pretty simple at Equiton. We pride ourselves in not overcomplicating this whole real estate Rubik's Cube, if you will. We have 3 products, 3 investments. We have 2 funds and 1 development investment. Now, the 2 funds differ slightly in strategy, return, and risk profile. One of our funds is, I'd say, a plain vanilla buy and hold residential real estate strategy, right? It is going to be the lowest risk, but also a little lower on the return spectrum. But it is incredibly consistent.
Can you touch that? And let's just call that Fund A, or do you guys have a name for it?
Yeah, it's called the Residential Income
Oh, perfect.
Fund.
Oh, that makes it real. Right. Okay. So it's called a Residential Index Fund.
Income Fund.
Income Fund. I apologize. Range. We won't quote you, and I know it's sometimes a touchy subject.
No, we can definitely talk about it.
Can you? Okay.
Oh, yeah.
What would be the returns in the Residential Income Fund?
So for the residential fund, we target returns between 8 and 12% annually.
Okay.
Now, of that 8 to 12, whatever it may be within that range, 6% is paid out in the form of cash flow.
Okay.
And that's paid out on a monthly basis. Now, the idea behind that is, especially the fact that it's monthly, is we want it to mimic actual real estate ownership. The idea here is you have $25K to invest in real estate. You know you want to be in the real estate industry or the industry, that asset class. But with $25K, you're not buying a condo. You're not buying a duplex, not in Toronto. Well, you're still going to be able to invest that in the asset class of real estate and still get a monthly income, just as you would with buying that condo. You're going to receive monthly rental income. It's meant to operate the exact same way.
Okay. Right? And in that, you guys call it the RIF?
We call it ERIFT, the Equiton Residential Income Fund.
Got it. Okay, cool. You can tell we like acronyms around here, man. In that fund, Equiton is purchasing like condos, multiplexes.
So another good question. So our mandate's very simple. We're essentially going out and acquiring 2 different real estate asset classes. One being apartment buildings, 2 being entire townhouse communities.
Okay.
So we're not going out and buying duplexes and sixplexes. We're buying institutional grade residential assets, 15-story towers with 200 units, let's say.
Right across Canada?
Geographically, our mandate allows us to invest throughout Canada. Okay. However, our entire portfolio is actually located here in Ontario.
Okay.
So these are going to be markets that much of your listeners or viewers are very, very familiar with. We have properties as far east as Ottawa, as far west as I'd say London and Chatham.
Okay, I'm a little biased. I think Ontario, specifically Toronto, and GTA gives the best returns over a long, overall 10, 15, 20 year window. In fact, if you look at the last 40 years, the GTA has outperformed really everywhere in the country and most places even in North America.